Both? Okay, I'd like to welcome all of you to our conference today. This should be a really interesting one, and I'm delighted to see all of you here. I'm Peter Wallison. I'm a senior fellow here at the American Enterprise Institute. Oh, here's our first questioner coming in. Bert always gets the first question.
Maybe I won't have a question.
Oh, it's never happened. All right, well, thank you all for coming. And we are really fortunate today to have with us Professor Sanjai Bhagat, who has written an excellent book called The Financial Crisis, Corporate Governance and Bank Capital. I think copies are available outside. And the book is on controlling systemic risk through better corporate governance, specifically making sure that corporate managers have a long-term perspective by giving them a long-term compensation, at least requiring their compensation to be of a long-term character. Professor Bhagat would achieve this by restricting their compensation so that options or restricted stock would be available to them only after they have completed their work at the firm. This is a really interesting idea, and Professor Bhagat's thesis is, in my view, the most effective implementation of an idea that many academics and others have been focused on since the financial crisis. After Professor Bhagat's presentation, we will explore this idea, he and I, in a conversation, and then we'll have some questions from the audience. So make some notes if there are things that you want to hear Professor Bhagat talk about. Now, he is the Provost Professor of Finance at the University of Colorado at Boulder. He has an MBA from the University of Rochester and a PhD from the University of Washington. His distinguished career includes work at the SEC, at Princeton University, and at the University of Chicago. Particularly relevant to today's discussion, Professor Bhagat has served as chair of the University Benefits Advisory Board, which advises the president of the University of Colorado on strategic compensation and health benefit issues. He has submitted several amici curiae briefs to the U.S. Supreme Court on class action litigation, and these briefs have been cited in court opinions. Please join me in giving a very warm welcome to my good friend, Professor Bhagat. Thank you, Sanjay. Watch your step.
Thank you, Peter. That was very kind of you, and I thank the American Enterprise Institute for hosting this event. So, the Dodd-Frank Act has imposed a huge cost on our economy, and it's not just the regulatory cost, though we have some numbers here. It has imposed the largest cost on those who can afford to bear that the least. I'm talking about the low-income Americans. The Dodd-Frank Act was especially designed to help the low-income Americans, and it has done exactly the opposite. So you might ask, how about the benefits of Dodd-Frank? Well, one of the more highly touted reasons for implementing the act was that they wanted to make too-big-to-fail banks a thing of the past. Well, after the presidential debates that you saw, and then the campaign discussion, as and when they did talk about the too-big-to-fail banks, that was one issue on which there was agreement on all sides, that these too-big-to-fail banks were still too big to fail. And if you were looking at some specific numbers, the Federal Reserve Bank at Richmond, they do like a monthly tally of the amount of financial liabilities in the country that fall under the federal insurance net of one kind or another. And that number was 60% before Dodd-Frank, and that number is still at that level, 60%. So what are we trying to do? Well, I have two complementary proposals, so they reinforce each other, and they will work better if both are implemented at the same time. The first has to do with incentive compensation of the bank managers. And when I use the term managers, I'm talking about the bank CEO and 3-4 other senior level executives in the bank. So the incentive compensation, we are recommending somewhat a very simple, but we think very effective incentive compensation plan for the bank managers and bank directors. Something you don't hear about in this conversation, in this media discussions, media concerns about the high levels of compensation both in banks and in the non-financial industry, is who sets the compensation of these CEOs? Well, that's the board. So, and there's very little discussion about the board's incentives. So we will talk about the board's incentive also, which I think is very important and more relevant. We'll show you some data as to why the board incentives also matter. And then the other part of our recommendation has to do with bank equity capital, and that is a key item that has received a lot of media attention with regard to the too big to fail banks. The idea was that they didn't have enough equity capital, and they still continue to not have enough equity capital, and there have been reasons proposed as to why they should not have more. But I think those reasons are not valid, and we will try to go through at least some of those. So one key point to note before I get further into this is we do not think that the misaligned management incentive compensation caused the last financial crisis, though we do think that it aided and abetted it. It didn't cause it, but it did encourage it. The cause of the crisis were the public policies that encouraged home ownership by those individuals who didn't have the income or the credit using historical standards to own a mortgage. That was the cause of the crisis. So we wanted to be clear on that point. So what were our proposals? What would they do? They will address this too big to fail problem, and the Dodd-Frank has a whole host of authorities and additional regulations that they have come up with. It essentially makes all of those items that you see up there, this orderly liquidation authority, that FSOC, the stress tests, exchange stabilization funds, all of these will become moot. So major amounts of deregulation, if you will. And then it also eliminates the need for enforcing the Volcker rule. The Volcker rule, if you've looked at the media reports on this, basically tries to keep the commercial banking and investment banking activities separate. And after 6 years and more than 300 pages and many long deliberations, the regulators still have not been able to come up with a way of enforcing Dodd-Frank. I mean, of enforcing the Volcker rule, and our recommendations, if they are implemented, will also be able to address that. So, what's our central thesis here, at least on the compensation side? So what we are arguing, and we'll show you some data, that bank managers invested in high-risk but value-destroying investments and trading strategies in the 2000 through 2007 period. So these trading strategies were such that early on in the life of these projects or these strategies, there would be large positive cash flows that will make the bank's earnings profits look good. And later on, there would be extremely large negative cash flows. So obviously, the bank will not look good at that time. That's what the bank's CEO and senior managers knew. Counter to this scenario, some people would argue that, look, why would you want to say that the cash flows would become negative down the road? How could you ever tell? And how would the CEO know? Well, one way you can tell, and this is the way to differentiate between the two stories. The good story is the bank managers are working hard. They'll invest in these risky projects that will generate positive cash flows now and positive cash flows down the road. These are just good projects. If that were the case, that's the good part of the story, then you should not see any unusual trading, as in selling of stock by the bank CEOs before the crisis. On the other hand, the bad and the ugly part of the story is that if they know that sooner or later this ship is going to hit the rocks, well, they will bail out before the crisis comes. And the way you bail out is you sell large amounts of stock and you exercise the option and then sell stock early on during this episode. So that's the way you differentiate between these two stories. And indeed, when you go look at the data, so I'm not sure if you can read these tables, but basically what we show is that if you control for the amount of shares the big bank CEOs held in the beginning of 2000, by the time we rolled around to 2008, the median CEO of a too-big-to-fail bank sold 60% of the shares. Well, some people will say that, people have, if you make somebody put a lot of shares, they are under-diversified. That's a valid point. They have liquidity needs. That's a valid point. So we compare the amount they sell to other bank managers of banks that were also pretty big, but not as big as too big to fail. But these are still pretty big, large banks, and control for the amount of shares that these CEO held. And none of these banks, what we refer to as the no-TARP banks, banks that did not ask for or receive the bailout funds, these bank CEOs sold 4%. So you compare 60 to 4. There are more formal ways of comparing it, but that is the huge difference. And that suggests that these too-big-to-fail bank CEOs knew that something bad was going to happen, and that's why they were unloading these shares. Okay, so the results that we have so far, that bank executives sold a lot of shares. And even if you take into account the big loss that they suffered in 2008, their overall payoff from these banks by working in these banks was still very handsome and positive, unlike the shareholders. So the too big to fail shareholders didn't do well over this entire episode from 2000 to 2008. The bank CEOs did well. So that's where the misalignment of the incentives. So what do we have to recommend? Well, what we are recommending for the bank's CEOs and other senior managers is this restricted equity proposal. It's fairly simple, and what you're seeing out here, the entire proposal, other than a small, modest cash salary, all incentive compensation of bank CEOs can only consist of restricted stock and restricted stock options. Restricted in the sense that the shares cannot be sold or the options exercised for at least 1 to 3 years after their last day in office. So what would this do? This would eliminate the incentive to engage in any short-run earnings management behavior, trying to increase the earnings in the short run, convince the analysts these earnings will recur, and have an increase in share price. Those incentives are all gone because now, even if the share price is high today, the manager cannot benefit from that personally through the sale of the shares because they have to wait until they retire from the company, and even then they have to wait for a year. Now, we've talked mostly about banks here, but the same set of incentive compensation proposals would apply to address the scandals that started with Enron, WorldCom, and Quest. In fact, my idea for addressing, for using corporate governance mechanisms, incentive compensation mechanisms to address corporate scandals, and then the bank crisis, it came from what happened in Enron. And if you go and look at the criminal filings, I mean, people did go to jail in those episodes. The CEOs did exactly what we just outlined. They would mislead the investor, mislead the analysts. Share price would go up. They would sell a lot of shares, and then they would, let the investors and especially their employee stock option plan, which was indeed, extremely disgraceful, and they went to jail for that. So maybe there was some justice in that. So under the restricted, if Enron's board had the wisdom to put a plan like the one that we just described, the restricted equity compensation plan, the Enron executives, the Quest executives, the WorldCom executives, and now most recently, the Wells Fargo executives, if they had had a similar plan, they would not have had the incentive to do what the Wells Fargo CEO was encouraging or at least abetting, and what the Wells Fargo VP of Consumer Affairs was doing. She was more concerned about her compensation now because that's the way her incentive compensation was set up. Under my proposal, she would have been thinking long term and maybe would not have engaged in that disgraceful behavior. Two key points. One is that we are not recommending any compensation-related regulations. Everything we are recommending can be implemented at the board level. The corporate board, the bank boards have the power, the legal power to implement everything we've said, number one. Number two, our proposals need not necessarily reduce CEO compensation, management compensation. There are other policies, policymakers, other think tanks that have come up with their own incentive compensation proposals, both for banks and for other companies. Almost all of these proposals, both in the US and internationally, call for a reduction in the compensation of the bank managers. Ours is the only one where we do not call for it. In fact, if the bank managers create long-term sustainable value in the banks, they could well earn significantly more than what they're earning right now. The only catch in our proposal is that value that they have created, that needs to be sustainable in the long run. Okay, on to director compensation. Similar policy that we are recommending that director retainer fees, which is the annual compensation, annual cash compensation, should go to zero. All director incentive compensation should again consist of restricted stock options, such that restrictions are such that they have to hold the shares or not be able to exercise the option for at least 1 to 3 years after the last board meeting. Why do I say that? One picture can be very effective. So you make 4 buckets of the ownership of the median directors. Now you're looking at the largest 1,500 US companies. So you're looking at both banks and non-financial companies over a very long time period, 1998 through 2012. So you take the ownership of the average director in each of these companies, US companies, and you put them in 4 different buckets depending on if they own more or less. What we are finding systematically, that when bank directors own more stock in their company this year, or even other non-financial company directors own more stock in their company this year, their company performs better next year and the year after. And I could slice this data up by different time periods, different industries, you get the same picture. The next, this other is a somewhat different way of thinking about governance. So the idea is that if a company is not doing well financially, if its share price is on the slide, then you think there should be some discipline on the managers. And what we are showing here is that when directors own more stock, that discipline comes sooner rather than later. Okay, so now to the other part of the complementary proposal, which is bank equity. So how is bank equity capital related to this incentive compensation? There are three links here. The first link is, since we are relying in our recommendations so much on, we are relying on long-term value creation for the banks, so much on the incentive compensation of the managers and the directors, well, that equity better have some value for there to be any incentives from that equity. And so that's what we know, is that when a bank's equity value starts going towards zero, that means the bank's equity capital ratio starts going towards zero, the incentives start to evaporate. So if we are going to rely on these bank managers' incentives, then we have to be thinking also about bank equity capital ratio. The other link is, what we found in our research is, in the cross-section, those banks that have more equity capital, their CEOs tend to sell a lot less stock. So there is some connection between CEO sale of the stock. If your bank has a lot of equity capital, you sell less. And the third link is, banks are businesses, though sometimes they look like regulated utilities. So as a business, they should take risks. I mean, that's what a business does. But these risks have to be intelligent risks. I mean, you have to make an assessment of whether or not the investment you're making will provide long-term value or not. But those are all risky proposals. Some risks in the world of business work out, some don't. So if some big risk that a bank undertakes does not work out, then we need to have a good equity cushion to absorb that negative risk, if you will, or the outcome of the negative risk, such that the bank shareholder or the bank does not have to go running to the taxpayer for another bailout. So what are we, okay, and before we give you our recommendation for bank capital, any bank capital reform proposal, and there are many out there. One is from the U.S. House of Representatives Financial Services Committee that I will get to. The FDIC Vice Chairman, he's come up with some proposals. The Federal Reserve, I guess now ex-Governor Tarullo, he's got his own proposal. So what we are saying is, any proposal, you should evaluate a proposal using three criteria. One is, it should be simple. Two, transparent. And three, it should be focused on creating and sustaining long-term shareholder value such that there is no need for another bailout. Okay, so what do we recommend? So we have like a bank capital recommendation. It has two parts to it. One is that bank capital should be calibrated to leverage. In the numerator, you have tangible equity, which is a lot more difficult to massage or finesse. So tangible equity is easy to measure, and it's the one that can absorb the losses that we talked about earlier. So that's what you have in the numerator. The denominator is where a lot of controversy comes. So we are recommending both on-balance sheet items and off-balance sheet items in the denominator, and no adjustment for risk. Basel has made a career of many of their economists and many of the regulators by coming up with rules on how to come up with these risk-weighted assets. And there is absolutely no academic evidence or any other evidence, any other scientific evidence that I'm aware of, that these bank risks have done anything of value for the investors in these banks or the taxpayers in these countries. all the evidence seems to suggest exactly the opposite, that these the risk-weighted assets have become mode for obfuscating both investors and taxpayers have to foot the bill eventually. So we have a very clean denominator on balance sheet items, off balance sheet items. The reason to include the off balance sheet items is because some banks have in the past were very creative in coming up what they would call structured vehicles that would be highly leveraged, and they would not include those assets in there when they would measure their equity capital. And what we are recommending is that the bank equity capital ratio measured thus should be at least 20%. Most people in this discussion would find that a high number. Let me give you some range. The vice chairman of FDIC, Mr. Honig, he's supporting a ratio of 10%, and his proposal was out just a few weeks earlier. But he's been a strong proponent of higher bank capital. I think, and he's got some other parts that are more consistent with what I have recommended. The U.S. House Choice Act, I actually applaud both what Vice Chairman Honig is doing and the U.S. Choice Act. The U.S. Choice Act is also recommending a 10% equity capital, but they also are focusing on tangible equity at the numerator and no risk weighting in the denominator. And the U.S. Choice Act also includes both on-balance sheet items and off-balance sheet items. So that's an excellent proposal. While they are at 10 and I'm at 20, I think that's a matter of degree, not kind. One of the reasons why I say that that 20 might be a better number to go with is people talk about 20 is, there are other academics from Stanford University who are recommending numbers between 20 and 30, and then very recently you've had some scholars from George Mason, Barth and Miller, and they do a lot of what I'd say fairly technical but very detailed work, but very carefully done, and they come up with a number 23%. And I'll try to give you some idea as to why that, it's a lot of work goes behind, but there's to be fair, there's a lot of uncertainty around that number 23. The number 20, some people would say it sounds like a high amount of equity capital. Well, high compared to what? Nobody has ever been able to show with economic data or reasoning as to what is the cost on the bank's investors, what's the cost on the taxpayers, what's the cost on society of having a higher level of bank capital. In fact, all the research seems to indicate quite the opposite, that when bank capital is low, there's all kinds of costs on the economy, costs on society. So that's the other side of it. I will, one of the arguments that are made is that if we increase bank equity capital, the cost of capital will go up. That is empirically true. So if the bank's equity capital went up by 10 percentage points, we have various research papers done by some that I've been involved in, but others have also worked on. The increase in the cost of capital is minuscule compared to the increase in bank capital, though there is a small increase. Now, this might be hard to read, but just bear with me. So if you increase the bank cost of capital, is the bank lending going to increase or decrease? Some people actually have found that even though when bank cost of capital goes up, actually some banks lend more, especially in an economic downturn. So that clearly would support the notion of having more bank capital. On the other hand, if you're willing to argue that, look, if bank cost of capital, cost of lending goes up, clearly there'll be less lending. That's the standard, microeconomics approach, and there is some evidence to that. Well, let's talk about that. So if bank lending goes down, how much is that going to impact the economy? So if you're looking at the U.S. manufacturing sector, for the entire U.S. manufacturing sector, they have three sources of capital primarily. They have the stock market, the bond market, and bank lending. for the manufacturing sector as a whole, bank lending is only 6% of the source of capital. So that's a pretty small amount, So even if banks lend less, there are other ways for companies to get financing. And on the downside, if banks have less equity capital, then we get the outcome that we saw in '08. There is a huge negative impact on the economy. Not only does the GDP goes down, the GDP becomes more variable, but even the higher cost is the impact on the labor force. We have 4.4 million Americans that are not working today that would have been working had we, even after you adjust for demographic changes, that would have been working if we were on the same labor participation trajectory that we were before '08. So thank you very much. Happy to take some questions or.
We're going to have a conversation.
Wonderful.
And there'll be time for questions afterward.
Sure.
Well, Sanjay, very, very interesting and intellectually stimulating conversation. I'd like to start with something that worries me a little bit, because what we're seeing today after the run-up in the stock market after Donald Trump's election is a lot of bank management selling. Mm-hmm. Now, what you said was that this means that they are likely to be foreseeing some problem in the future. Isn't that what you meant? And should we be worried about this?
Anytime, as a general proposition, anytime you see managers, senior managers in a company selling a lot of their stock, what they are voting with their feet. They're saying that they are less confident about the long-term prospects of the stock than what the market appears to be at that time. Now, as I mentioned earlier, there are some legitimate economic reasons for selling, and those have to do with diversification and liquidity. But there are formal econometric models to control for that. And even after you control for that, if you find that bank managers, whether it's in banks or in non-financial companies, if you find that they're selling too much, that's not a good sign about their confidence in their own company.
That's right. Well, I think that's logical. That makes a lot of sense. But how would a bank manager be able to determine whether his bank, her bank, is taking a risk?
Well,
or taking that, let's say, taking an excessive risk, which is basically what you're after. Not risk-taking per se,
right,
but excessive risks.
Yeah.
How
I think that's a very that's an excellent question, and you worded it very well. Taking excessive risk. So the corporate finance, or the finance way of looking at projects, risky projects, basically you try to get some sense of the expected level of cash flow if you were to invest in this project or invest in this trading strategy today. What will be your cash flow next year, year after, 5 years from now, 10 years from now, and so forth. So those are all your best guesses. Now, banks and other corporations, they have they have some historical data to work with, and they use their best guess as to what the expected cash flow will be. Then they also use models or the best guess as to how variable this cash flow will be in year 1, in year 2, and year 3, etc. And looking at the expected cash flows and the variability in these cash flows, now I'm doing some simplification here, they first decide upfront whether or not this investment project is worth undertaking. So the sense that I'm trying to give you is that the bank managers have a lot of leeway in deciding whether a project is worthy or not. All projects are risky. The question is, are the returns high enough to justify the risk? And ultimately, it's a judgment call. So no amount of finessing this that investment banks would like you to believe or banks would like you to believe. I mean, there is no way to finesse it. That judgment calls are involved in this. And all that our proposal does is it gives the bank managers and the directors who are monitoring and advising them the incentive to pay very close attention to getting that judgment call right for the long term.
Let's talk then about risk and capital, because at the very end you were talking about the importance of capital, recommending a 20% leverage ratio, which is about twice as high as the Hensarling bill, at least as originally drafted, the Choice Act would have proposed. Two things have been said about that, at least in my conversations with people around Washington, including people in the banking industry, and especially among the large banks. One of their points is if you had a 20% leverage ratio, the banks would be unprofitable. That's the first point they make. That is, too much equity makes them unprofitable. Questionable, but that's one of the arguments. The other one is that it actually encourages them to take more risk, because if they are unprofitable because of the high leverage ratio, then in order to earn the profits that they need in order to keep their shareholders happy, they have to take greater risk. That is an argument for the risk-based capital system, which you, I think, justifiably are scornful about. But what do you think of that second argument? More risk will be taken in order to compensate for the lack of profitability that comes with a 20% leverage ratio.
Okay, so you had two questions. The first is, if we have a higher level of equity capital, the banks would be less profitable. There is absolutely no empirical evidence that I am aware of that would validate that. In fact, all the evidence would suggest the otherwise. I mean, we don't even have to look at a lot of academic research on that. Just look at what happened in 08. Banks had very little equity capital. How did that turn out for the banks and for the taxpayers? Number one. Then the other point about that if they have to have so much equity capital, then they will be less profitable, and hence they'll have to take additionally higher risks. Well, the argument on less profitability is not a valid argument. Will they take on more risk? Well, that's why I have the complementary proposals. So I have the bank capital backed up with the incentive compensation both at the CEO level and senior managers and the board level. So I want the CEO and the board to be very focused on the long term, because yes, you want to invest in a risky project. All business projects are risky, so I'm not against risk, but I'm against risk that at least if they were to make a careful, unbiased assessment, those risks are not worthy. Those risks have a negative net present value in the finance sort of way of talking. So the CEO and the board is not like, if they know that all of their incentives are long term, they're not likely to engage in high risks that in the long term view are going to be value decreasing. So I'm just working on the incentives, and I've shown you some data. There's data to suggest that when board members own more stock, companies do better, not worse. When CEOs, in those companies where bank CEOs sold very little stock, those were the companies where the bank had a high level of equity capital, and the converse is also true. I don't want to mention any names, but many of the big bank, too big to fail bank CEOs, I mean, the behavior was disgraceful. I mean, they're selling hundreds of millions of dollars of worth stock every year, and they're telling us that they have a lot of confidence in their company, in their bank. I mean, now this is where I sort of feel good about justice in the cases of Enron and WorldCom and Quest. Those CEOs went to jail. What's happening in Wells Fargo? Disgraceful. And a lot has to do directly with the incentive compensation of the Wells Fargo VP of Consumer Affairs and the incentive compensation of the CEO, whose compensation is, I think, somewhat short-sighted. If his compensation was focused on the long term, he would have paid more attention in instructing his subordinates that, look, everybody better pay attention to the long run. I don't want any of these short-run gimmicks. I mean, one of the points that I didn't mention is everything I'm recommending only applies to the very senior most level of executives in a bank or any other company. We have nothing to say about mid-management incentives. You get the incentives right at the top level. We are not interested in micromanaging. Let the CEOs do their job. It's the job of the CEO to figure out what the right set of incentives are for the next level of managers and so forth.
Well, actually, let's explore this a little bit, because it's a very interesting and powerful point I think you made about Wells Fargo. The people in Wells Fargo, I haven't studied this, but the people in Wells Fargo who were signing up all of these people unknowingly to the customers that they were being signed up for these things, those were middle management people. There were people at the top who knew about it, and this is your point, if they had long-term compensation, they might have stopped that. But nevertheless, it was the people down below who were getting bonuses, and maybe even stock bonuses, for signing up unknowing customers. How do you excuse the middle management from your setup when they can have a major effect on whether a bank wins or loses?
Excellent question. Again, we are not claiming any expertise about incentive compensation or compensation structure for middle management, and we are not interested in micromanaging. Our recommendation, if it had applied to the vice president for consumer banking, which I suspect would have fallen in this level of senior executives, or at least she would have been fairly close to the CEO, so the CEO would have been paying attention. From what I understand, her compensation had a lot to do with short-run performance in the various branches of Wells Fargo, especially how many additional accounts they were generating. So, I mean, that incentive compensation was asking for behavior like this. Now, why would the CEO have signed off on an incentive compensation like this? Well, I mean, there are whole mechanics of how they get this compensation structure, and there's and I don't want to get into the weeds here. But let's forget about what they did wrong. Let's talk about what they can do right. What they can do right is the incentive compensation for the CEO is focused on the long run, and the CEO will then find a way to tell the VP of their consumer affairs, look, my compensation, everything I'm getting, incentive-wise, is only focused very, very long run. And either he would have directly intervened and said, we cannot have these going on, or made sure that the VP of consumer finance in Wells Fargo in compensation also had the same long-term characteristic that the CEO has. But again, we want to refrain from getting into this micromanagement business, get the incentives right at the top level. These people know how to get the incentives right at the next level and so forth.
Okay, so we're talking about, if I understand you correctly, we're talking about what you call too big to fail banks, or too big to fail firms. Let's clarify this. Much of your talk was about banks, but I think you're saying all financial firms, all firms. Which is it? What is it?
Well, in the context of Dodd-Frank, I mean, they have banks and other financial institutions. They call the sci-fis. So AIG or insurance company could fall in that, and at some point G Capital was that until it got spun off. So our compensation principles apply not just to banks or other financial companies. Our compensation principles actually will apply to all companies, financial and non-financial. That is why I took up the example of Enron and Quest and WorldCom. That, I mean, in fact, that's how I sort of learned about this over time. I mean, I didn't just wake up one morning in 2008 and said, this is what went wrong. I've been seeing this movie. I've seen this movie play itself out several times before that, back in 2001, 2002. So like I've been seeing this thing play out, and now we're seeing it again with Wells Fargo.
So too big to fail banks or financial institutions in general would be covered by your program here. But I assume not just too big to fail banks and other financial institutions. Any financial institution ought to be covered by this, but the ones you are worried about are those that are too big to fail. Okay, how do we know which institutions are too big to fail?
Well, that's one of the strengths of our proposal. We don't have to get into specifying what the threshold is before which you become too big to fail. Our recommendation is for all banks, bank holding company. I mean, like, this is for the entire set of banks, big and small. As it turns out, for the smaller size banks, their both capital ratios and the incentive compensation already looks a lot like what we are recommending. And that's one reason why these smaller mid-sized banks do not create a lot of trouble for us. So that's an aside. But we are recommending this same proposal, and we are not saying one size fits all either. We are saying that there are several moving parts to our compensation proposal. In the broad, it's about long-term compensation incentives. But we are specifically asking the board to decide how much of stock, restricted stock, and how much of restricted stock options. What is the proportion between stock and options? And then how much is the time that the manager should wait after their retirement or resignation from the company before they're allowed to sell? I said 1 to 3 years. There's nothing magical or written in stone about 1 to 3 years. For some banks or some companies, the board may decide, look, after 6 to 12 months, we'll have a pretty good idea, what long-term value has been created or not by this CEO. So the board may tell the CEO, look, in your case, we'll let you sell half of your shares after 6 months and the other half after 12 months. So we are intentionally asking the board to make those decisions, but we are saying, look, start with this very simple and transparent contract, then go ahead and make changes around the edges, but every change you make, be very clear why you're making it.
Mm-hmm. Let's talk a little bit about the financial crisis, because that's your principal example. That's where the whole system seemed to crash because of a lot of risk-taking. But let's look at what happened in the financial crisis, and I think we agree actually on this, and that is that the financial crisis was actually caused by government housing policies that caused a very large bubble in housing values to occur in our economy, and when that bubble deflated, collapsed, that caused a lot of difficulties for the banks that were holding these mortgages and so forth. But do you think that as housing prices rose as they did during this period between, we'll say, I think my numbers would be 1997 to 2007, rising in some cases about 10% a year, do you think that bank managers actually thought they were taking risks in what they were doing? Or were they simply following what seemed to be a pretty strong market in residential mortgages?
Well, I don't know what was in the minds of the managers. I can only tell you that the data we look at is consistent with the argument that they knew that short term these things are looking attractive, long term they're going to be extremely negative, and they were responding to their beliefs with regard to the trading. Now, the other question about the increase in home prices from 97 to 2007, well, I mean, that's been a very historically an exceptional period for home prices. In our books, if you have that, if you go look at chapter 2, in fact, the very first graph that we have in the book in chapter 2 is from Robert Schiller of Yale University. He has a website where he's sort of, you can go and look that up. He's got home prices, or the national index of home prices adjusted for inflation. So for the longest period, going from about 1890s to about 1995, the home ownership index was basically flat, and then it went up, as we all know, and then it came down, as we all know, and now it's gone up a little bit. But if you look at the longer historical norm, and if you think that the longer historical norms are what are applicable, going forward, for any bank manager or anybody looking at this data, I don't know how they would expect that 10% would be a defensible rate of return on investment in housing real estate. I mean, the data suggests that the rate of return is positive, but nowhere near 10%.
So it's the fact that their rate of return is so high, or the cash flows that they're expecting are so high, is a signal to the management that they are taking possibly excessive risks?
Well, excessive risk in the context of that the returns were smaller than what would be needed to justify that level of risk.
Mm-hmm.
So, I mean, the level of risk that they undertook, that by itself is not a problem if they were expecting a higher level of return. And again, they can show you the spreadsheets, but anybody that has worked with spreadsheets, I mean, you can put any numbers you want there, but just because you put the numbers there doesn't mean that that's the way the home prices will evolve or that's the way the economy will grow.
Okay, well, I think we have a pretty good idea of Sanjay's point of view, so we're ready for some questions. And of course, Bert always gets the first question when I'm here.
Thank you, Peter. Bert Ely, a banking consultant here in town. I have a comment and a question. The comment is this, that leverage ratios, in fact, are risk-based capital standards, because what the leverage ratio says is all assets, whether they're treasuries or second loans on sketchy property, have the same degree of risk. So I think it's very important to keep that in mind, that leverage ratio is in fact risk-based capital. My question is this: when you take a look at these capital ratios that you're proposing in the context of a leverage ratio, no risk-based capital, what capital arbitrage opportunities does this provide to the capital markets? In other words, you seem to suggest that regulated banks would constitute the universe of sources of finance for the economy, but we know that is not the case. To what extent are you concerned that non-bank operators, Wall Street people, would come along and basically skim off the lower risk assets? This comes back to Peter's point, and because the markets would determine that the low risk assets don't need a capital ratio as high as what would be dictated for the banks. So again, coming back to Peter's point, doesn't that kind of leave the banks stuck with nothing but buying or investing in higher risk assets that require at least as much capital backing as the leverage requirements, as your capital requirements would require?
So two responses. One is that you're arguing exactly the same point that Basel, the sort of organization, central bankers in Switzerland, I mean, they've argued that, and obviously very successfully. And see what kind of a mess they've gotten us into it, and they continue to argue for that when scholars, including in their own shops and various in the World Bank and IMF and various universities, have looked at is it the case that when we look at risk-based asset, do these assets, when bank capital ratio measured using risk-based assets, do they provide investors a better idea about the returns of these banks or the future survivability of these banks? The answer is no. In fact, they confuse the investors, number one. So that's the, this Basel adherence to risk-based assets, the only way of justifying it provides, what I'd say, good employment for a lot of their staff and economists, and that's the only reason to have that. I have not seen a single positive scientific, objective study to defend those risk-based assets. The other point I think that you were alluding to, so some people have argued that if you keep the bank capital ratio too high, then the bank lending will go into this shadow banking sector. The shadow banking sector, I think as you look at Mr. Wallison's nice editorial today, he has in the Wall Street Journal some discussion of that. So the shadow banking, is where I mean, they do the same thing as the bank without any monitoring or access to any deposit insurance. So, the shadow banks, they come in various flavors. One of the type of shadow banks are the structured vehicles that were very heavily involved in mortgage financing or mortgage bond financing. Now, these shadow banks don't come up from thin air. Somebody organizes these, somebody forms these, and somebody owns these. So you have to go up, like as I say, follow the money. You have to go after who organizes the shadow banks, who owns them, who's getting the payoff from the performance or the lack thereof of the shadow banks. As it turns out, some of the big banks were involved in the formation of the shadow bank. To the extent they are, we would like to bring in those assets also in the denominator and then measure the equity capital. And if they want to do, I mean, I'm letting these banks do whatever they want. That's why in my proposal, the Volcker rule becomes a non-issue. I let the banks do commercial banking, investment banking. I said, you can do whatever it is you want, as long as we get the incentives right at the top, and as long as you keep enough equity capital such that the taxpayers don't get on the hook anytime soon.
Okay, more questions? Yes, right here in front.
Thank you for your presentation. It's wonderful. But I just wonder, for the too big to fail and Dodd-Frank, I think maybe first of all, you have to think about the way they do business. It's not just lending, and it's important. First, you have to separate how do they spend the money or investment, whether there's a hedge fund or whether there's speculation or whether there's for their constituents or their account holder, rather than spend their money, get the most benefit while they victimize their account holders. You know what I mean? About your data or record, if you want to study whether their account, let's say for instance, basically number of account. A lot of financial institutions, not just too big to fail, but also credit union, they can eliminate account by abandon of property and then take all their assets away. And on the other hand, they can maintain the minor account even they are all grown up and they are all victimized, their assets all gone, but they still maintain a lot of minor accounts, so they maintain their customer, a lot of customer, something like that. So, and they can also, let's say, of course, with the government agencies, so the lower level employee is very important because they do just all the misconduct and they pretend CEO didn't know anything. So if you can just address this type of issues and then maybe limit the financial institution to their local area, if they register with the state agencies
I think
and
we
federal
understand the
agencies,
question.
separate them.
Thank you. I think we understand the question. We'd like to make sure there are others too. Go ahead. Do you want to?
Yeah, no, I mean, as I understand it, I mean, there is a concern that some of these banks were very aggressive in terms of their lending practices. But, again, some of that may have to do with the incentives at the very top. They would be fined, even though they know that in the long term, look, I mean, in the long term, any business cannot survive by systematically having a plan to lend to people that cannot pay them back. So any business understands that. If you still see them doing it, well, then you have to think about why in the short run they want to do that and why in the long run they're less concerned. And that sort of evidence is consistent with the notion that in the short run the bank senior managers were benefiting from this through their incentive compensation structure. And in the long run, they were expecting to get bailed out, and their expectations were not entirely false. I mean, they were right that they were going to get bailed out.
Yes, sir.
Thank you. Good afternoon. My name's Todd Wiggins. I would like to ask you, Sanjay, a question that's similar to that which I asked Peter back in the old building, if you recall, once you released your book. And that was, how much of this did you anticipate prior to 2008? Because you did make a good point. You said, I didn't just wake up in 2008 and realize certain things. I had been studying these, as you pointed, quote, since 2001. So in retrospect, how much of what you've incorporated into your theorems here was pertinent prior to, say, 2008, 2005, around that time when this was all starting to develop, percolate, if you will?
Well, I mean, I had not looked at the data on the CEO trading, until the crisis. But I sort of knew that there was, that was at the core of the problem with Enron, CEO and the CFO, both, well, one went to jail. The same thing happened in Quest, WorldCom. So I knew that looking at incentive was a very powerful way of understanding how corporations behave. And it's not just in the context of, banks and this sort of Enron and CEO. I mean, this is the notion that if you look at the incentives of senior executives, you can have a pretty good sense as to what the company will be doing. This has been validated in literally hundreds of studies in the broader area of corporate finance, law and economics, law and finance. So I knew that one place to look when we had the crisis was to go look at the CEO incentive. So I started looking there, and I showed you what I found. Now, with regard to 2008, I was skeptical for other reasons, and that has to do with a lot of the popular, commentators and media and folks who are not what I'd say, deep into quantitative finance. They would give the banks, and to this day still give the banks a pass that they are a black box. They're doing some magnificent things, creating things of value inside, and we better not do anything to disturb it. Now, they do some things of value, but I was not exactly persuaded as to what valuable things they were doing, because I knew some of the people, what they were doing and the model they were implementing. And I'm saying, these models are fine at the theoretical level, but these models have their ability to predict prices of real estate based bonds is so weak. I'm not sure how you could, structure all these bonds on this basis. And, they apparently were claiming that they could until we had the crisis. And then, as you might recall, I think there was a time when in fall of 2008, the president of the country and the secretary of treasury on live TV said that these models are so complicated that nobody knows how to value them. I didn't see any of my bright investment banking colleagues who were very convinced about their quantitative methodologies raise their hand and said, we know how.
Yes, sir, in the back.
Thank you for a great presentation. I'm William Michael Cunningham. I run Creative Investment Research. So I'm a graduate of the Economics Department at University of Chicago. I like some parts of what you've done. My question concerns something both of you have agreed on, in which I think you're wrong, but I'm going to ask you to clarify for me. You and a bunch of other people continually blame this financial crisis basically on minorities, basically saying that these government policies that were designed to get home loans into some of these communities were the first part of the blame for the financial crisis. And then admitting that the incentive structure for the managers was a contributing factor. I think you have it exactly backwards. So what I'm going to ask you to do is to walk me through a specific example of a government policy, walk it through the bank, walk it through the balance sheet, walk it through the investment process, that is tied to this so-called government mandate that primarily created the crisis. Finally, the responsibility for any financing and investment decision rests with the financial institution making that decision.
Well, I really thank you for your question. I thought, wanted to, I guess, address that in my presentation if I had the time. So I really thank you for your question. I'm not suggesting that the source of the crisis or the cause of the crisis were these homeowners that, of low income, low credit, or low income, not good credit. They were not the cause of the crisis. The cause of the crisis had to do with the policies that would encourage them. Now, the reason why we had this crisis was this whole chain of ways that the dollars flowed from the U.S. Treasury through these banks, through these mortgage originators, and then that would come back into the sort of structured vehicle that we talked about. So, if we as a society decide that home ownership is a good idea and that people should be able to afford homes, I'm not opposed to that policy. It'd be a lot simpler to administer that policy if the U.S. Treasury wrote checks to those homeowners that we think should own homes. That would be a lot simpler, a lot transparent. We'd see what's going on, how much it's costing us, and it would cost us a lot less than what you're seeing from that last crisis, and we are still paying those costs. And the human cost of the crisis is still unfolding. So, if we want people to own homes, I think it'd be a lot simpler to just write them checks and take out the big investment banks and the too big to fail banks and all this sort of, what I'd say, the whole series of financial players, credit rating agencies, there's a whole series of them. Get them out of the equation, because the discussion is about helping the people own homes. The discussion is not about providing benefits to investment bankers or mortgage brokers and so forth. So I'm not opposed to that, but just let's do it directly.
Let me just say that you ask a very good, intelligent question. And if you are really interested in the data for how this happened, there's a book written on this subject. It's called Hidden in Plain Sight. And if you take that book and read it, I would love to talk with you about it after you've read it. But what you'll find is that government housing policy was at the root responsible for the very weak loans that were made because the government was willing to buy them. And in the year 2008, just before the financial crisis, I'll just give you one piece of data that is, I think, demonstrative of the problem. In the year just before the financial crisis, more than a majority of all mortgages in the United States, this is not in any sense minorities, all mortgages in the United States, a majority of all mortgages in the United States were subprime or otherwise weak mortgages. And of those, 76% were on the books of government agencies, principally Fannie Mae and Freddie Mac. And that, I think, without question, means that the government created the demand for those mortgages. That was the housing policy of the United States. And everything else, the bubble and the collapse of the bubble and everything else, resulted from the huge amount of leverage that the U.S. government poured into the housing system. So I'll be happy to talk with you at length about this, but I'd like you to read the book first, and then we can.
I already have one. I've read a bunch of other books. I filed amicus briefs. Well, in 1997, we filed a suit to try to get the Federal Reserve to review their policy of getting rid of Glass-Steagall as part of the Citigroup Travelers transaction. Okay, so I have a very long history in this, and then we filed a number of other amicus briefs in the U.S. Court of Appeals for the D.C. Circuit. So I appreciate your response. I do. You're wrong, but we'll talk about it. But I appreciate that. Once again, the key responsibility for any financing decision rests with the financial institution making that decision. Unless you can show me a picture of a government agent coming into a lending underwriting room with a gun and forcing a bank to make a loan, then I'm sorry, according to your private market, private sector theories, the responsibility rests with the financial institution.
Well, we probably shouldn't take everyone else's time here to respond to that, but I would be happy to talk about that with you off camera or whatever it is, because there's plenty to be said about that subject. Okay, other questions? Yes, sir.
Thank you, Mr. President. Thank you, Mr. Sanjay Gupta, for a wonderful analysis, and obviously the last very, very important answer, which really brought about more serious discussion. And as you were saying that you will have it. I have a very short question. You see, I want to talk about the marketplace. You see, there are two points of views of looking at a thing. One is a particular bank, the management itself, middle or upper, it all functions as a big machine now, too big to fail, as they say. But there is a marketplace. There were a large number of institutions, financial institutions, regulatory bodies. Then there are places like American Enterprise Institute, looking at all the economic data and the market. I mean, in terms of wealth, what happened in Wells Fargo recently, I'm sure the competitors in the market knew what was happening. Why it took so long for things to come out?
I mean, if you're asking about Wells Fargo, I mean,
just a recent example.
yeah.
I'm not going as far back as Dodd-Frank. So much has been written and talked about. I'm just taking a recent example as to why the marketplace, there are good players in the market, always good players in the market. Majority of the financial institutions are good players. Majority of the stocks on the Wall Street are good players. That's what they keep the market going. If something goes wrong somewhere, the marketplace always corrects itself. It has a way of correcting itself. So how do you look at this larger micro level of the marketplace?
I mean, that again is an excellent question. Why did the market not anticipate these things? So, look, I mean, the market sort of knows only the information that the company provides. The market also looks at additional data around that, and the market analysts make the best guess of what the company's future cash flows would look like to come up with the current share price. But nobody is saying that these share prices are infallible. In fact, we know share prices change and there's a lot of noise to it. So when we're talking about, and I sort of am a believer in this sort of what they call the efficient market notion, how do you want to think about an efficient market? Do you want to think about an efficient market as one where if the market prices change up or down by a lot, then the market is not efficient? Or do you want to think of it differently? A more useful definition or way of thinking about an efficient market that many people in finance adhere to is the notion that if you cannot systematically generate economic profits from a trading strategy that you can define up front, then that market is efficient. So as much as we saw the run up in the share prices of these investment banks and the real estate prices, to the extent that you didn't know when it'll come down or if it'll come down, and you couldn't come up with a systematic trading strategy that could be implemented, well, that market is still efficient or can still be called as efficient.
It's random.
Yeah, I mean, these things, I mean, the stock market moves up and down a lot. That by itself does not tell us whether or not it's efficient.
I'm also talking to practical banking examples, the practical banking examples of a particular bank. I mean, that's why I specified about Wells Fargo. I mean, it was out in the market. Everybody knew that the multiple accounts are being maintained. That was the major problem. But there were many good competitors in the market, and as they are competing in the financial market, and as they do at Wall Street, at any stock exchange around the world, so the beauty of the marketplace, the beauty of the market economy, is that it has a way of exposing its own weaknesses and correcting itself. SEC or not, Dodd-Frank or not, market always finds a way of correcting itself. So we have to have, we do rely, I believe the system does rely on this particular economic notion.
Ken, would you have a question? Introduce yourself, please.
Dr. Bhagat, are you confident that heightened reserves, say for example 20%, would prevent a similar event as what we saw in 08 and 09, a similar kind of crash, given that we know for a fact that the mark-to-market fair value rules were applied in a manner that securities which had no actual losses, mortgage backs, were devalued by, decimated really, by 60 to 70%. And they were still flowing cash as was expected. So have you looked at the numbers to see if that extra reserve amount would be enough to keep taxpayers off the hook?
Okay, so I referred you to that earlier recent paper that came out of George Mason, or the Mercator Center by Barth and Miller. So there are a lot of moving parts, and some of the moving parts are on the slide up there. To come up with the optimal amount of equity capital, you have to take into account first what's the impact of the increase in equity capital on the cost of capital. Does that increase lending, decrease lending, and if it decreases lending, how does that lending get made up, and what is the impact on the GDP there. On the downside, if things go wrong, what's the impact on GDP, volatility in the GDP, impact on the labor markets. So you have to make lots of assumptions. You can try your best, and they did a heroic job. They do 235 sets of simulations. Behind each simulation, you have literally thousands of iterations of whatever that model says, and they come up with an average number 23% equity capital. Am I confident that would 20 be enough? I mean, one can never be confident, but what I'm saying is, if you get the incentives right, and let's get the equity capital to a significantly higher number than what we saw in 08, the equity capital numbers we saw were like 3%, 4%, 5%, and even those numbers were measured with a lot of what I'd say in a not a very clear manner. So what I'm saying is, let's measure it in a very clear, transparent way. Let's go for a number like 20, get the incentives right. I think that will solve a lot of problems. And I'm not just saying it, in other contexts, getting the incentives right has done a lot of good for investors in many companies. So this is not a statement that I'm just making on the basis of my research. There's a whole body of research that suggests if you get the incentives right in corporations, good things happen. And correspondingly, if you don't, then
Sir, I didn't mean to imply that you did this off the cuff. What I'm really saying is that in the face of that kind of decimation of values which were present, cash flows which were intact, what in the hell would save us? To me, and I've studied a lot, the logic of the competing interests of arm's length parties.
Let me
Go
try.
ahead, Peter.
Let me try to answer this, Ken, because I know where you're going. You've got a very good point here. There was a tremendous crash in these values as people realized that they had no idea how serious the crisis was. The values went way down. They came back up 2 years later because you were correct. The cash continued to flow to these securities. But the point is that I think, and this is probably what Sanjay is thinking, is that every company is diversified. That's how you really protect yourself against risk. It's diversification. So they would have had an investment in these mortgage-backed securities, which could have crashed. That in itself, however, would not cause the banks or the other financial institutions to come close to failure. That would be a loss. I don't know what you call that as a kind of loss, but it was an unusual loss. But the the institution as a whole, especially if they had 20% tangible equity, would have still been well capitalized because only a portion of their assets would have declined. I think that's probably what you were
That's a much
getting at. We have to get,
better answer.
there's one more question, Ken, I appreciate that, but we're going to have to, one more person has a question. And then this will, I think, be the last question, unless there's someone else who has a question. Okay, there'll be one more over here with Tom. Okay.
Hi, I'm Ray Carr. As a former regulator and now a financial services consultant, I'm wondering whether you have thought through and considered the implications of your compensation restrictions in your proposals. I'm thinking of things like, what's it going to do? What would it do to executive turnover? What would it do to compensation levels? What would it do to attracting managerial talent to the regulated financial services compared to unregulated financial services? And how does that factor into your proposals?
So we've thought about that, and we have some discussion of that in the book about specifically about management turnover. And I'm not going to try to finesse this. Under our proposal, you'll have more turnover than you would otherwise. The question is that really going to be that disastrous for either the bank or the economy? And this is where I sort of, I sort of have some understanding of, what is it that these bank managers do and what value they create. If they want to move on, I think there will be other managers willing to step in. This notion of somebody that is totally irreplaceable, I do not subscribe to it. There is no evidence to that. So yes, there will be higher turnover, but there's no reason to believe that that's going to have a significantly negative effect. Now you have to weigh that with what we have seen. Not taking the action that we are recommending has led to this financial crisis that we are still living through. So they're the other side of the coin. So that's one. And I think you also mentioned about not being able to attract talent to the bank with a compensation plan like that. And that sort of sounds a little, I think back in 2009, winter of 09 or spring of 09, you might recall many of the bank managers that were those too big to fail had received the bailout funds, and they were when they were hiring new bankers, they were giving them cash, very substantial cash bonuses, and the argument was made exactly what you just said, is that we have to give them these bonuses, otherwise the talent will walk. And my response to that was that a minimum definition of a company with a lot of talent is that that company should be solvent. You just went to the taxpayers with your hat in hand, and sometimes it looks like that the only talent that the banks have is the talent to convince the media and the regulators that they have talent.
Okay, one more. This will be the last question.
Hi, my name is Thomas Jennings. I appreciate your presentation today. I'm not aware, even though what you say is plausible, I'm not aware of any financial institution that has adopted compensation policies that you're recommending. And how can we test what you're saying? Where can we start? Do we need the capital requirements changed first? Or do you have any ideas on getting these financial institutions to make these changes other than legislating it?
Well, I'm not recommending any regulation. Everything I'm recommending can be implemented at the corporate board level. That's where the legal authority resides on compensation, and they can also make those decisions on the capital structure if they chose to. Your other question, has any bank adopted this? Not exactly the way that we are describing, but the way you do empirical research, you get as close to what you're recommending and see if the data suggests that if things were adopted, that would move more in the direction that you're recommending. That's where we showed you that where in companies, both financial and non-financial, where directors own more stock, they do better That's and some data that we talked about that in that where banks have a higher level of equity capital, those CEOs tend not to sell their shares too much. So this is suggestive of what we are saying, but I don't know of any bank that has exactly what we are recommending.
Is there a bank, well, just let me clarify that. Is there a bank or other financial institution that has divided its compensation in such a way as to have a large proportion of that compensation go only after the officer has left the employ of the bank?
So,
and what is the record of that, if so?
Okay, some of the banks are moving their vesting requirements. So they're extending the vesting requirements, which is moving in the right direction. Our proposal has very long vesting periods, so that's the issue of length, and our vesting is anchored around their departure date, not when they receive it. So there is a tendency, you're seeing a trend both in banks and in non-financial companies towards the kind of compensation that we've outlined. In the book, we give you some more data on that. The same thing is happening with director compensation. There is a trend towards compensating them more with restricted stock than used to be the case even 10 years back. So they are moving in that direction. The SEC, the FDIC, the Federal Reserve, and 3 other agencies, just last summer, they came up with what they call the incentive compensation arrangements in accordance or in pursuant to Dodd-Frank. They had to come up with incentive compensation proposals for bank executives, and they have moved a lot towards what I'm recommending. Like they're recommending longer vesting periods, clawbacks, and so forth. Some things create problems that I haven't gone into, nor do we have the time to. But so they are recommending things moving in the direction. I would just have them, make it a lot more simpler, and let's just get there, because they're trying to move in the direction and they're moving it in like half steps, and often they move there in very complicated ways. And one of the things about our incentive compensation is, if you want to have these compensations be effective, they need to be simple, transparent, and geared on the long-term value creation. Many of the compensation proposals or programs that you see currently in banks and in non-banks, and in proposals that come out of regulatory agencies, they tend to be complicated. And I don't understand why we need to have complicated incentive compensation proposals. I mean, if you ask a director or a CEO, what is your objective? Most of them at some level would say, we are trying to maximize long-term shareholder value. Well, good. That's called the long-term share price. We are done.
All right, ladies and gentlemen, I'd like to thank our guest, Professor Sanjai Bhagat, for his wonderful presentation, and thank you all for coming. Please join me in a round of applause for him.
Thank you. Thanks a lot, Peter. That was